Well, welcome everyone. Welcome to Office Hours with Michael Kitces. So for this week's Office Hours, I want to talk about the rising popularity of financial advisors discussing behavior management as a key value proposition for clients. Usually framed as, will help you manage your behavior and avoid selling out at market bottoms, which frankly is something I think a lot of us advisors have advocated as part of our value proposition for a long time, but it seems to be getting a lot more popular in recent years. And I think in part that's just because we're starting to use it as a way to differentiate from robo-advisors and technology. Saying they just allocate your portfolio, but they won't be there to hold your hand when the bear market comes. I, the financial advisor, will be here to help you, keep you from making a mistake and selling when at the wrong time. And I suspect part of the rising popularity of talking about behavior management is just because most of the studies coming out these days about the value of a financial advisor attributes a significant portion of the advisor value add to that behavioral management component. We've had studies, Morningstar's Gamma from David Blanchett, Vanguard's Advisor Alpha, Investnet Sigma, each attach as much as half of the total advisor value add to the behavior management component, closing the so-called behavior gap. And after all, with a behavior gap as much as maybe 1.5% a year of inferior performance with ill-timed investment decisions, depending on whose research you're using, if the advisor can help clients stay the course and close that gap, then in theory, if my advisory services cost 1.5%, my entire fee is free because it's covered by the behavior management piece alone, and all that other financial planning advice, retirement and tax and other stuff, it just gravy as value add on top. But the problem is that while it may end up being true after the fact, the client who would have sold at the bottom but didn't ends up making our entire advisory fee back in the long run just from an intervention at one crucial moment that matters. Or even more generally, just because the advisor helps clients overcome all those behavioral finance biases that distort investment behavior over time. I don't think it's an effective way to show our prospective forward-looking value to get clients to work with us in the first place. Because ironically, the biases that impair the decisions of some investors also impair their ability to realize they need help and should pay for it in the first place. And so to understand why this, you need an advisor to help you manage your behavior framing. But let's imagine that you've decided you want to hire a financial advisor. You're getting close to retirement. You need some guidance about proper timing of claiming Social Security. Wouldn't mind a second opinion, just confirming you've got enough to retire and your spending is reasonable. And you realize that you probably need some help with your retirement portfolio because looking back, you made a few mistakes over the years. You were a little too exuberant about tech stocks in 1999 and got hurt a little. It was only last year you finally sold that ill-timed rental property you bought in 2006 that got slammed in the financial crisis and took a decade to recover its value. Now, fortunately, you are ready to retire in your retirement savings, and you've accumulated a very healthy $1 million account balance. So clearly, it hasn't all been bad. You saved and invested your way to $1 million. And so you start going to shop, and you check out the website of Summit Financial Advisors, and you see this value proposition. Our value is helping our clients manage their bad investment behaviors, which research shows can be 1.5% or more per year of investment drag. So the first thing that investor, that prospective guy probably thinks is, I wonder how much I've underperformed. I've never really compared it to anything else. I don't know. I guess I did lose some money on those tech stocks back in 1999, and that rental property obviously didn't work out very well. But I have accumulated $1 million for retirement, and the media says that most people aren't going to have enough to retire, so I must be better than average. Maybe I've been losing 0.5% a year on average. So the first problem you'll notice is that while we might talk about a behavior gap of 1.5%, the prospective client assumes that must be other people, not me. Because the typical affluent client already knows that they have above average wealth and retirement savings, and so they're going to naturally presume they must be above average investors. Now, in truth, it's more likely that they had above average income or above average savers, not necessarily because they were above average investors, but most consumers don't know the difference. They don't do the math on savings versus investment performance and calculated time-weighted, dollar-weighted returns to figure this out. There aren't that many consumer tools that can show you your investment results relative to a benchmark. Retail and online brokerage platforms certainly don't show you. If they did, more people would realize how bad they are and stop trading, not good for their business. So most platforms don't give good tools for self-directed investors. Most consumers don't know how good or bad they really are at investing relative to a benchmark, or they can't distinguish long-term investment results from long-term savings behavior and the relative contribution of each. Now, of course, this isn't the end of the process for the potential client evaluating the advisor. Perhaps this whole behavior management thing sounds kind of appealing because the investor does recognize bad tech stock buy in 1999, bad real estate purchase in 2006, assumes he's probably losing 0.5% a year, which still matters. So he and his wife come into your office for a potential meeting. And as the advisor, you start asking them about their needs and their goals, and you start asking them about their investment experience, and they mention the 1999 tech stock losses and that 2006 rental property fiasco. And as the advisor, you start pushing, well, one of our primary value propositions is to help you manage your behavior so that you don't make these kinds of big mistakes again that in the future could derail your retirement. Right? Because I want them to understand what's at stake here. You could derail your retirement if you make one of these mistakes once you retire and you're exposed to sequence of return risk. But now I want you to think about this from the client's perspective, right? The client says, whoa. Okay, we've made one or two mistakes along the way. Who hasn't? But I'm not going to derail my retirement. I'm proud of what I've accomplished. I've done a pretty good job to get our family to where we are today. To which the advisor responds, well, I know you've done some great work saving and investing already to get to where you are, but as you pointed out, you did make some mistakes with those tech stocks back in 1999 and that real estate property, and I suspect if you measured your results, you'd find you've already been giving up 1 or 2% a year in returns. And the client says, okay, I admitted that I made some mistakes in the past, but you don't have to rub them in my face. These were stressful times for our household. I had to get a side job for 2 years in 2004 to make up the money we lost in the tech crash so we could put our youngest through college. And frankly, we brought that rental property in 2006 because we were still trying to make up for lost time. But we've gotten through that now. We have enough to retire. I've learned from those prior mistakes. I'm not going to do that anymore. And the advisor says, well, we've worked with a lot of clients who said that. But I've been an advisor for 20 years. I've seen how our clients react in times like the tech crash of 2000, the financial crisis of 2008. I've had a lot of clients who said they weren't going to make a dumb mistake and sell at the bottom, but when the moment comes, you're not thinking straight. Emotionally, these bear markets can get really scary, and a lot of people make irrational decisions. That's why it's so important that we will be here to hold your hand through it. And the client responds, wait, did you just call me dumb and irrational in front of my wife? I'll have you know I put myself through college. I built my first business with my own 2 hands. We put two kids through college, paid in full, and we managed to save $1 million. So maybe I don't have your fancy investment strategies, but I think we've done pretty damn well without you already, and I don't need to sit here and be insulted. It's funny how that conversation can go sideways really fast, isn't it? Because the fundamental problem that starts cropping up, the tension that gets created with this approach of hanging our hats on the behavioral finance component is that it requires the prospective client to admit, to acknowledge, to embrace that they've made mistakes, that they made bad mistakes, and that they're so hopeless that they won't be able to stop themselves from making those mistakes in the future. And the only way to be saved is to let you, the advisor, do it instead. And if it's a couple where usually one spouse is primarily responsible for managing assets, you're asking that person to acknowledge in front of their spouse that they're so bad, so hopeless, so incapable of learning, that the only solution left is just to walk away and hand it to you, the advisor, to manage instead. And the end result in most situations, I think you're going to find that most clients at best get defensive and then decide to walk away from you, and at worst are actually insulted when you try to make your case about the value of behavior management. Not because the point that you're making about their investment stakes and behavioral issues isn't true. It may very well be. But making it a core value proposition requires the prospect to admit to themselves and their spouse and their loved ones that they failed and that they failed beyond the point of recovery. And that's a hard thing for anyone to admit, even to themselves, much less to anyone else. We do not try to convince us of our failures than to admit it's a problem and hire the advisor, which means the advisor, you don't get the client by leading with, we'll help you manage your investment behavior, because it's a situation where you can only win and prove your value proposition by dragging down your client's self-confidence and self-image in the process. Now, to be fair, the reality is that there is a subset of advisors who really are this bad at investing, and they know it, if only because they made the mistake over and over and over again, and they really are ready to just walk away and let go. And you don't have to prove to them that they're bad investing and suffer from behavioral biases given their own results. And so it's not news to them to say there's a behavior gap. These are clients most likely to say, yeah, every transaction is a buyer and a seller and a winner or a loser, and I'm usually the one on the losing side that gets it wrong. For this type of client, The one who's already surrendered their problematic investment behaviors because they sold the bottom in 2000, they sold in 2002, they sold the bottom in March of 2009, they sold when the news came out about Greece and then missed the rest of the run-up, all the stuff that's happened the past couple of years. With this type of client, who's already surrendered to the problem, absolutely it's a value add to help them, and there's nothing wrong with showing them your value proposition. Because for this type of client, when you say, I'll be there to hold your hand so you don't panic in the next bear market, they'll reply, yeah, I know I need the help. I blew it in the tech crash. I didn't get back until 2007. I blew it again in March of 2009 and sold it, and I've been out for 9 years. I just can't do this on my own. And the reality is that we as advisors do see a lot of these clients because, frankly, they're the ones who seek us out. Because, as we said, they know they're bad at making investment decisions. They know they're bad at managing their own portfolio. They know their results have been bad. They've accepted this about themselves and need to make a change, given this string of bad results. That's why they contact us as an advisor and say, I need to work with someone to get some help. But in the end, I fear this is only a small subset of investors. Yeah, the behavior gap data in the aggregate tells us that a lot of investors aren't very good at investing, but most of them don't know. They don't even have good tools to measure, and they certainly haven't acknowledged it about themselves, accepted it, changed their self-image to the point of saying, geez, I just have to stop touching this stuff altogether because all I do is turn gold into lead instead of the other way around. For the rest, they might be below average investors, but they don't know it or realize it, particularly in a bull market where their account balance goes up every year. Or maybe they think they can improve and get better even if they've made past mistakes. And trying to convince them that they need behavior management is doomed to fail because it requires them to make a very negative change about their own self-image. And most people just don't want to do that. Living in denial may be an unfortunate problem, but telling someone in denial about a problem to stop being in denial about a problem rarely actually makes them stop being in denial about the problem. Which means to me the whole idea of leading with will help you manage your investor behavior is, I think, really more of a niche solution than a mainstream one. For that small subset of investors who really are bad at investing and they know it and they've accepted this about themselves and they want help and they want to delegate, great. Serve them, help them, give them the value they need. But for the rest, again, I'm not saying we don't add value by helping all clients make better investment decisions. But setting your value proposition up to only work with those who have to first admit they're terrible at this themselves may be more limiting than you realize about who you can work with. And even worse, it risks obfuscating, it risks distracting from, risks completely eliminating all the other value that we can provide and all the other clients who just want to pay us for advice and expertise about all the other parts of the financial planning value add, the retirement expertise, the tax expertise, guides about insurance and estate decisions, help with cash flow and budgeting, prudent savings and spending habits, all those things we bring to the table. I love Mitch Anthony's framework for this in particular, that the value of financial advisor is organization, accountability, objectivity, proactivity, education, and partnership. 6 powerful value adds for clients that are all predicated on having a good financial planning relationship and may indirectly impact behavior, but aren't built around the idea of saying, you need to hire me because you're too incompetent to do it yourself. Now, again, by all means, let's keep adding real value to ongoing clients by helping them avoid problematic investment behaviors and biases that damage their portfolio and long-term returns. We may retain a lot more clients when we get to sit down with them and say, remember that time in 2009 in the spring when you wanted to sell everything and I convinced you to stay on, and look at what we've accomplished in the 9 years since. It's a tremendous value to retain clients. But just because it's valuable to retain clients, and you can prove after the fact that you added value with behavior management, doesn't mean it's necessarily going to be very effective to market hand-holding and behavior management as an upfront value proposition for an advisor. Because in the end, it's only compelling to that small subset of clients who are really willing to acknowledge and accept that they're so bad at it themselves and so hopeless and incapable of learning that they have to hand off their portfolio to you, which I fear just isn't that many people, if only because denial is still one of the most powerful behavioral biases of all. So I hope that helps a little, some food for thought about communicating the value of advice to clients and what may or may not attract clients to your advisory firm. This is Office Hours with Michael Kitces. We're normally 1 p.m. East Coast time on Tuesdays. Obviously, we're a little bit late this week, but thanks for joining us at the unusual time, and have a great day.